Good morning, this is Connor from 0DTE Traders, here to present the week ahead for October 13th, 2025. Let's dive in. To start the week, GEX, which measures dealer gamma exposure, is negative, 780 million notional, trading below both transitional levels, 6680 volatility flip and 66700 gamma. Those transitional levels are visible on the notional gamma chart. 6680, all strikes above positive, that is supportive for the market price. All strikes below negative, that is destabilizing for the market price. Now, this transition from positive gamma to negative gamma occurred on Friday, breaking through the then 66950 gamma level, fueled by renewed trade tensions following President Trump's comments threatening a massive increase of tariffs on Chinese products, accusing China of being hostile, and said there was no reason to meet with President Xi. Since then, Trump has said kind things on Truth Social, had a phone call with Xi, and they are scheduled to meet in 2 weeks. The S&P 500 is up 1.5% in the pre-market. But we're not out of the woods yet until price reclaims the transitional levels and positive gamma builds. Now, keep in mind the levels we quoted here today are as of this morning. Options positioning, gamma exposure is very dynamic, and these levels can change on a day-to-day basis. For members, make sure you're going over to the dashboard and getting the updated levels every morning. As of now, negative GEX is the current regime. It is a risk-off environment where puts are dominant and dealers hold a short gamma position. In this regime, dealers are no longer supportive of price and must hedge by selling weakness and buying strength. In other words, chasing deltas. Now, when we talk about GEX, think in terms of realized volatility. This relationship is clearly highlighted on the SPX return distribution chart. On the x-axis, we have the GEX value. On the y, the SPX close over close percentage change. Zero gamma level here in the middle, with each dot representing a day. When you're in positive gamma, you have a narrower return distribution, lower volatility. When you're in negative gamma, you have a wider return distribution, more volatility. And we're sitting at negative 780, so around here. So we do anticipate elevated volatility. Now, keep in mind, this doesn't only occur on the downside, but also the upside. So some of the biggest market rallies occur from a negative gamma state. It is a destabilizing market and overall a challenging environment to trade. Now, the last period of sustained negative gamma occurred from late February through April 25th. This was driven by Trump's trade crackdown. I think we all remember that period. However, we don't anticipate a return to the market conditions seen earlier this year. What we're witnessing is likely a case of the art of the deal in action, creating leverage ahead of the U.S.-China trade agreement expiration scheduled for early November. In his book, Trump describes saying bold things later and walking them back as a deliberate tactic, a way to test reactions, build leverage, and remain unpredictable. It's less about inconsistency and more about controlling the narrative. Now, if you haven't read The Art of the Deal yet, I don't know what you're doing. This is his second term. He essentially reveals all of his tactics, and maybe what's going on will make a little bit more sense if you've read the book. So if you haven't, I do recommend picking that up. Taking a look at the SPX chart, this is the monthly time frame, big picture view with a macro upsloping channel connecting the 2020 low. We did test, we kind of grinded below that the upper bound of that channel over the past couple weeks. So it's not surprising we see a bit of a pullback, loss of momentum, some consolidation at this juncture. Now, obviously, Friday's down move was quite violent, a lot of force flows associated with that. And as a result, we do have some structural damage on the daily chart. So we have an upsloping trend line connecting the May 2025 low. This is one test, 2, 3, 4, 5, 6. So we broke it on the 7th test. We also took out the most recent daily low at 65.69. So apart from our transitional levels, we do look at this as a critical level for the bulls to reclaim. On the downside, we have some potential support in the form of moving average, the 50 SMA at 65.39, the 100 SMA at about 63.23. So potential targets, and of course, potential bounce points. When trading 0DTE and negative gamma, our attention shifts to the major gamma strikes, the 50s, the double zeros, as that's where all the liquidity is present. And it's not unusual to see 50-point intraday swings in this sort of market. Now, what is challenging about playing levels in negative gamma is that their reliability goes down. Matter of fact, reliability goes down for all technical indicators due to what is known as feedback loops, forced flows in the market. So, for example, if you break a resistance level, it's going to invoke more buy flows. If you break a support level, it's going to invoke more sell flows due to that chasing of deltas. So trying to pick those turning points based on levels, very challenging. Now, one thing we like to use are trend lines, drawing those intraday upsloping and downsloping trend lines, not only to ride the trend, but also, to identify those intraday reversals. Another key variable is the VIX. Implied volatility tends to trend in negative gamma, so monitor those peaks and troughs at key levels. As volatility often leads price, so the VIX tends to move before the SPX. The VIX is also key to determining feedback loops. You have an upside squeeze. This occurs when there's a big contraction in volatility. Rapid decline occurs when there's a big spike in volatility. Presence of these feedback loops should also be reflected in our market conditions signal as a +2 bullish for an upside squeeze and a -2 bearish for a rapid decline. Also, on the topic of volatility, sophisticated traders tend to volatility adjust by reducing overall risk, exposure to short volatility strategies, and or tightening spread widths. Now, our advice is not to shy away from volatility. It is a trader's greatest ally, but to capitalize on it through asymmetric structures such as 0DTE single options and debit spreads. The week ahead, with the U.S. government shutdown showing no signs of ending and delaying key economic data, and amid renewed concerns over a trade war, participants are likely to be cautious after Wall Street suffered its worst sell-off since the April tariff shock on Friday. Participants will also receive additional catalysts this week in the form of inflation data, the kickoff of third quarter earnings season, and Friday's option expiration. On the calendar, CPI is due out Wednesday, PPI Thursday, and housing data on Friday. On the earnings calendar, major U.S. banks will be in the spotlight. JP Morgan is set to announce its results on Tuesday, along with Goldman Sachs, Wells Fargo, and Citi. On Wednesday, Bank of America and Morgan Stanley will report. Investors will also get financial updates from Johnson & Johnson and American Express. Keep in mind, guys, markets pull back and correct. That's a natural part of their behavior. While we may be in a secular bull market, the path is not linear. These are ultimately healthy developments that help maintain the market's long-term stability. Our job as traders, as risk managers, is to identify when these shifts are taking place and adapt accordingly. So as always, keep the risk managed. Best of luck out there.